Hello everyone, here is the answer to exercise 4 in unit 6 of AC201. In this problem we are going to be factoring receivables. We're going to be selling them outright to another company who specializes in this, and we're doing this so we can get cash now. We don't have to wait around for the receivables. The factor that we're selling to is going to wait around to collect those receivables. Why would they do this? Because they're going to end up making money off it. They're going to charge our company a finance charge up front, which is going to be their profit for doing so. So we're not selling our receivables for what they're worth. We're selling it for something less because we want to have the cash now instead of sitting around and waiting. To make the entry for this, when you factor a receivable, you need to know certain things. First things first, you need to know what the book value of your receivables is. So in this example, Wilson Wire is going to factor $50,000 worth of receivables. You need to know what charge the factor is going to charge you for buying your receivables, and it's usually based on a percent of the receivables that you are selling. In this case, Commercial Factors is going to assess a finance charge equal to 4% of the receivables that they buy from us. These receivables, maybe they collect all of them, but most likely there's bad debt involved in here. They're buying receivables, and a portion of those the people are never going to pay. The factor knows this, so they're going to make the company that sells it, they're going to make Wilson Wire, put some money on deposit in case there is bad debt involved within this transaction. And that is also based on a percentage of the receivables. So Commercial Factors is going to retain 6% of these receivables for probable adjustments. You need to know if there's a thing in there called a recourse provision or not. And what a recourse provision is it means that the company selling the receivables to the factor is liable to pay the factor for any bad debt that's contained within those receivables. And this one does have recourse. And when there is recourse, the company that is selling, well, they know their customers better than the factor does. So they're going to want to go through, look at the receivables that they're selling, and make a good estimate of what amount of bad debt they actually think is contained within those receivables. And Wilson Wire is determining that the fair value of this recourse provision, the bad debt, is $2,500. They're going to have to end up paying $2,500 in bad debt in here. They're going to end up having to pay to Commercial Factors. The first thing we need to figure out is what amount of cash are we going to receive if we factor these receivables. You start with the book value of receivables, which is Wilson selling $50,000 of receivables. You also need to figure out what amount of money the factor is going to retain for adjustments, the amount they're going to hold on deposit in case there is bad debt. And you figure that out by taking the amount of receivables factored and multiplying it by the percentage of retention. And in our example, Commercial Factors is retaining 6% of the receivables. So there's $50,000 of receivables. 50,000 times 6% is 3,000. You need to figure out what the charge is the factor is charging your company for buying your receivables and waiting around to collect on them. Commercial Factors is charging a finance charge equal to 4% of these receivables. So take your receivables factored, multiply it by that finance charge percentage. 50,000 times 4% is 2,000. Yes, we're selling them $50,000 for the receivables, but they're going to hold on to $3,000 of this in case there's bad debt involved in here, and they're going to charge us $2,000 for the privilege of paying us early on these receivables. So if you subtract both those from the $50,000 worth of receivables, you get $45,000. They're going to transfer $45,000 to us as we transfer these $50,000 worth of receivables to them. Now we need to figure out what our expected net proceeds are from this sale. So the first thing you do is you take the cash received at the time of factoring, which we just determined was $45,000. That amount that they're retaining from adjustments is a receivable for the company that factors. So for Wilson Wire, that amount retained for adjustments is a receivable called due from factor. If that money they're holding on to, that deposit, doesn't incur any bad debt, well, they have to send it back to us. They're just holding on to it. They're not charging us that. So we can expect, if there's no bad debt involved at all in these $50,000 of the receivables, that we're going to get $3,000 back from the factor that is due to us. But our accountants went through, looked over our customers and we don't think that's the case. We think there is bad debt in here, and we think the fair value of that recourse provision, that recourse liability, is $2,500. What does that mean? They're holding on to $3,000 now, but to our best estimate, we think that there's really only $2,500 worth of bad debt in there, which means they're holding on to $500 too much, which they're going to have to give back to us if that bad debt, isn't there. So our net proceeds are going to be $45,500 in total. The $45,000 in cash we received plus the $500 extra that they're holding on to for probable adjustments right now. And you can figure out your net proceeds by taking your cash received, adding the amount that's being retained, the due from factor, and subtracting out the fair value of your recourse liability. All in all, we are selling them $50,000 worth of receivables, which after we settle this recourse liability, we think is going to lead to us having $45,500 in cash coming in total, which means we're selling these receivables for $4,500 less than what they look like on our books. That is going to be our loss on the sale of receivables. So how do we book this? Well, we start by recording the amount of cash we are receiving, and we just determined in that first step that the amount of cash that Wilson is going to be receiving is $45,000. We have to put that receivable on the books, the amount of money that the factor is retaining, and they have to pay us back if there's not any bad debt, and that was $3,000. And we have to record our loss, which we calculated in that third table to be $4,500. These are all going to be debits because they're all assets, except for the loss is like an expense, and they all go up on the debit side. We have credits as well, and the first one is to that recourse liability. We think there's bad debt in there. We think there's $2,500 worth of bad debt in there that we're going to end up actually having to pay. The factor is going to take out of that amount that they're retaining. And then lastly, what else has to come off the books right now? Those receivables, because we sold them, and they come off the books at book value. So the journal entry to record the factoring of receivables with a recourse provision should always have a debit to the amount of cash you are receiving at the time, a debit to the amount of money that the factor is holding on to for probable adjustments, a debit to whatever your loss is, because you're never going to be selling receivables at a gain. It doesn't work that way. That you're always going to give you less than the face value of those receivables. That's how factors make money. A credit to whatever you think the fair value of your recourse provision is, and a credit to accounts receivable at their book value. To do another similar example, on June 1st, Banjo Board Games is going to factor $20,000 worth of receivables to Frank's Factors, and Frank's is going to assess them a finance charge equal to 4% of the receivables. Frank's Factors is also going to withhold 5% for probable adjustments. Why? Because these receivables are being sold with recourse. Banjo knows their customers better than Frank's does. They think the fair value of that recourse provision is really $500. That's the actual amount of bad debt that is in the receivables that they are selling. It's the amount that Frank's is going to make them pay afterwards by taking it out of that amount they're holding for probable adjustments. Let's do the same steps over here. What is the amount of cash being received? Well, the book value of receivables is $20,000. The amount retained for adjustments is a percentage of those receivables. In this case, it is 5%. So if we take the $20,000 in receivables, multiply it by the 5% that they are retaining for probable adjustments, Frank's Factors is going to hold on to $1,000 in case there is bad debt in here. Frank's is also going to charge Banjo a finance charge. That's how they make money, off of buying these receivables for us and waiting for them, waiting to collect from our customers. That finance charge is a percentage of the receivables as well. They think it's 4%. So 4% of $20,000 in receivables is $800. So yes, we're selling them $20,000 worth of receivables, but they're going to hold on to $1,000 in case there's bad debt, and they're going to charge us $800 for the privilege of transferring cash to us now, which means that amount of cash that's going to be transferred is $18,200. Now we can determine our net proceeds. We're getting $18,200. The factor is holding on to $1,000 from probable adjustments, which is due to us, Banjo Board Games. If that bad debt isn't in there, if all that receivables end up getting collected, they got to send the $1,000 back. But we think that the fair value of the recourse liability is $500. That's how much they're going to end up taking away from us for bad debt contained within the receivables that we sold them. Which means right now they're holding on to $500 extra. Their amount retained for adjustments is $1,000, but we think the recourse provision is only $500. So if we add that $500 difference to the $18,200 in cash that we're getting now, in total, the sale of receivables is going to lead to us seeing $18,700 in cash. And again, you can figure this out by taking your cash received, adding the amount retained for probable adjustment, your due from factor, and subtracting out the fair value of the recourse provision. So we are factoring receivables with a book value of $20,000, and we think that in the long run we're going to see $18,700 from this sale, which means we are selling them for $1,300 less than their book value. To record the entry of this factoring, we start with the amount of cash being received, calculated in our first table was $18,200. We put a receivable on our books for the amount that is due from the factor that they are holding on to for probable adjustments, which is $1,000. We record our loss on the sale of these receivables, which was $1,300. We record a credit to recourse liability for what we think the fair value of that recourse provision is, and Banjo is estimating that it's $500. And we take the receivables off the book at face value, $20,000. Now, later on, as of December 31st, Frank's Factors collected $19,800 worth of receivables that are purchased from Banjo. So we sold them $20,000 worth of receivables. They actually collected $19,800, which means there's only $200 worth of bad debt in those receivables that we sold. Well, guess what? There's a recourse provision, which means Frank's is going to, take $200 from us to make them whole because there's $200 worth of bad debt in there. And where are they going to take it from? That amount they are holding on to for probable adjustments. We're going to record the journal entry for the receipt of the remaining amount the company was due from the factor on December 31st. And the first thing we got to do is record how much cash the factor is going to send to us. Well, to figure that out, you take your due from factor and you subtract out your actual bad debt. As we see from the June 1st entry, they were holding on to $1,000 for probable adjustments. There's only $200 in bad debt in there. They take the $200 out of that amount that they're retaining, the deposit, if you will, and send us the rest, which in this case is going to be $800. Next up, we got to take that recourse liability off the books. We're settling this recourse liability, which means we can't have it on our books anymore. We don't owe anything. We're not going to owe them for the amount of bad debt that's in here. We're settling the sale of these receivables, which means we're going to take that off the books for whatever we put it on, which is $500. We're going to have, in this case, a credit to loss on sale of receivables, and we're going to figure out how much that credit is by taking the fair value of our recourse liability at the time we put it in the books and subtracting out our actual bad debt. We estimated that the bad debt contained within these receivables that we sold to Frank's Factors was $500. It only ended up being $200. Well, we used that amount of bad debt when we calculated our loss, which means we overstated our loss. So the difference between those two numbers is $300. We have to reduce our loss by $300. And then lastly, what else has to come off the books besides our recourse liability? The amount we expect to receive from the factor. We put a $1,000 receivable on the books at the time we made the sale. We are settling with the factor, which means we got to take it off the books. So we're going to credit due from factor for $1,000 when we settled our recourse liability with this factor. Does this loss make sense? Is the first question you have to ask yourself. Well, what in total did Frank's end up taking out of us, when we sold them these receivables? Well, they charged us $800 up front. We sold the receivables with recourse, which means we had to pay them for any amount of bad debt that was contained in there, and the actual amount of bad debt was $200, which means that's $1,000 that Frank's Factors took from Banjo Board Games on the sale of these receivables. Well, let's look at our journal entries. On June 1st, we recorded the factoring of these receivables, and on December 31st, we settled the outstanding, amount with our factor. We settled that due from factor, the receivable. In the June 1st entry, we debited loss on receivables for $1,300. In the December 31st entry, when we found out that the bad debt contained within those receivables was less than even we were estimating, we reduced our loss by the difference, which was $300. So what is the outstanding balance of loss on sale of receivables just from these two transactions? It's $1,000, which was our actual loss. So at the end of the period after you have settled with your factor, the balance of your loss should always be equal to the finance charge that happened at the time that you sold, plus the actual amount of bad debt that was contained within the receivables that you factored.